Yeah, we've got quite a new tool set here. They the folks at Pie Trade just keep raising the bar every week. I know I've said it. Those of you are probably bored at how much I'm seeing their praises. But look, they partnered with me to take my intellectual property, the Roar, and it's not just Roar. It's it's the idea of constructing portfolios, and I'm going to walk through parts of that today. We're going to prep some video tutorials, things like that, for this. And if you're on this call, it means that pretty soon you will, whether we're seeking alpha or you're with us on Substack, you're going to be among the select few that will be enjoying not only this site but ETF yourself, which is where all the writing is, and I think will continue to be for a while. But you're going to get that combination package, if you will, the writing and the articles on the one, and the analytics on the other, and the whole thing's going to be $600 a year, which we think is a pretty steep discount. So much so that, as you'll see in the newsletter today, that price is going to be probably close to $1,000, like within weeks, and will be exposed to a exponentially larger audience, just because we have a really good distribution partner in this. So I think I love the idea that we're able to take what we do, for the people that have been with us for a long time, people who join us recently. But I love the idea of providing first mover advantage in a professional service business like this. So yeah, we're pretty delighted about that. Okay, let's talk markets now. I, and when we do talk markets today, I'm going to try to use this as much as possible. I think I'm still getting used to using it myself, but I wanted to make sure that you caught some of the new enhancements over here, because this really is the chalkboard, the playground, whatever you want to call it. Um, we're trying to do everything we can to try to simplify this. At the same time, I don't mind telling you every day, I love the Roar score for stocks. I love it for ETFs, and I absolutely love it through the roof for portfolio construction. And the more that we look at what's available out there in the fintech space and what is not being made available that should be, the more we realize there's a huge gap. And I really do think that we are going to lead the way in filling the gap. What is the gap? Everybody is teaching you how to pick stocks and funds and how to look at the broad market and guess what the future is going to be. I like doing that too, but it's not how you make money. Maybe over the short run, it's not how you make money over the long run. Over the long run, you make money by managing risk, playing offense and defense at the same time, making sure you avoid big loss, and committing to some type of structure. And the structure is very simply what we call an investment portfolio. And so if you want to build effective portfolios, you have to think of it a little bit more like a sports team. And I mean, like, I don't know, a basketball, hockey, football team, all on the field or the court at the same time, working in sync. And you got some players on the bench. Very different from playing tennis. It's you or at most one other person playing doubles, and that's it. So portfolio management really, to me, is a team sport. I was always a huge team sports guy growing up, still am, still a big sports fan, probably use too many sports references for some, but the point is it's all supposed to fit together, and you win games when the team wins, not because you have the best player. And I was having a conversation today. I was just interviewed by somebody for an article that's going to come out soon, I guess. And one of the things we talked about is how now more than ever there is so much sameness in markets. I mean, look at what's happening here. Now, look, you would expect these three to run together, the Qs and the DIA and the SPY. They're all at a 50 roar score. And you can see SPY right here. Okay. It kind of fought this wall of worry, but to its credit, and let's see, can we click on there? No, we can't click on that one. Hold on a second. I just put it in up here. Enhancement request. We're going back and forth with this stuff constantly, the enhancements. Okay, so if we zero in on this here, okay, I'm talking about SPY, but I'm also talking about the broader market direction because you have to build a portfolio with at least some view of broad market direction. And you either have to figure out what your own discipline is going to be, or you can develop your own methodology to figure out, hey, I can always make money, but sometimes there's a lot of risk attached to making a dollar, and sometimes there's not that much risk attached to making a dollar. You might have $3 worth of risk, or you might have 50 cents worth of risk compared to that dollar. And right now we are in a phase where I think I'm not surprised to see this. Okay, yes, it's driven by the war and the whole thing, but as I wrote in the weekly today, this right here, it's actually been going back for a little longer than this. Okay, is just a trading range. I would love to see it pop out of here, but honestly, I don't really care where it goes, because if you have a process, mine is Roar, okay? Doesn't have to be everybody's, or you can use pieces of it, but you know, having a process so you can take the offensive weapons, the defensive weapons, create a portfolio, and then manage the portfolio. Obviously, this is not a environment here. The stuff that I coach on, it's not an environment for the buy and hold forever. That said, because I think we get this question from time to time, it's like, well, shouldn't just buy and hold things. That's one way to manage a portfolio, and this is kind of where we're going to expand, I think, and really focus on portfolio construction. That is my expertise. I can tell you my best year and my worst year, and I've done a good job in my professional investment career in avoiding big loss. But what I really do, the real craft that I practice, is putting that sports team together. That figuring out how many buckets I'm going to have, how many ETFs, how many stocks, how many are going to own at one time. Am I always going to own them or not? Okay, so these are all sort of like portfolio management or portfolio construction tenets. So where does that boil down to today? Well, yeah, if you're a long-term investor, great. If you want to focus a lot of things around the SPY, this is not a terrible time to do that, to make it your hub and add some spokes around it. They also in Wall Street call this either hub and spoke, or they call it core and satellite. Okay. And why do I say it's not a bad time for SPY to be the core of a portfolio? It has nothing to do with what the Roar score is now, or what the Roar score has been, over the last 5 years. Okay. That said, I mean, fortunately, I'm glad to say when it gets through the red period here and you see a lot of green, that's good. Okay. I mean, it can be a longer term indicator. You just have to decide what your tolerance levels are. Okay. So, no question in my mind that it works, and that you can build portfolios around it. I'm going to show you this too. So, uh, the reason that I think SPY is a great core holding in a lot of cases, it it has nothing to do with timing or anything like that. Okay, uh, because you have a much better idea of what you own. One reason I always like the Dow: 30 stocks, you know what you own. Uh, you don't have to have things coming at you from left field. It's like, oh, why was it down? Oh, because that little holding just imploded or whatever. Okay. The S&P has 500 stocks, but most of them don't count. 25 to 50 of them is about the whole thing. The rest of it, very small positions. They're just along for the ride. But the thing about SPY is not SPY, it's the markets. The markets are basically correlated. I'm doing some studies on this right now. I can't wait to show them to you, and I'll show them to you first, of course. But everything is so correlated. And I think all you have to do is look at when we have swings that are strong in one direction or the other. In fact, wasn't sure how much I was going to use this here, but this is kind of a finer point, but that's what this group is for. Okay. What I'm watching in this market right now, I'm always watching the 20-day moving average. In my opinion, and I have some research I'm doing on this too, the 20-day moving average, I was asked a lot of like desert island questions today. Well, what would be the ETF that you would own if you were on a desert island? Or what would you suggest to your kids or whatever? Okay. Good questions. Great session. But the the thing that I realized was, if you watch the 20-day moving average of most securities, it tells you what's going to happen probably 80% of the time. I'm going to try to put a statistic to that. But I think that this is the guiding light. And look, I'm not so wonky on this stuff that I can't, that I can tell you exactly, what makes that happen. Only that markets trend. And so when I see this, I know that in Roar terms, the Roar score is going to go pretty low. I think all the way down to 20, even 10 for a day. But that doesn't mean that there's no chance that things can rally. In fact, it often gets darkest before dawn, as they say. And in a perfect world, if I put myself in the position of many in the industry where it's like, well, I can only buy stocks and I have to buy stocks, so therefore I always have to be a cheerleader for the stock market. Always give you a reason why it should go up, as opposed to just saying, I don't care. My goal is to make money, not to make money when the market goes up. So, when I see this thing whipsawing like this, and you can see it even better in the PPO, okay, that's not a healthy pattern. It's a pattern that is likely to burn itself out quickly, probably because it's very focused on news. Why? Because the market is always trying to recalibrate. And this, frankly, makes technical analysis a little bit more difficult. Good thing I have a system that I can rely on now. The Roar score might as well be called Robo-Rob. Okay. Because remember, we've been talking about this for a while. Slow, slow, slow decline in this. Okay. We had a market going up. We had a PPO, think MACD, but in percentage terms, not dollar terms. Okay. But more importantly, don't worry about the strict definitions. You had a market that was basically going up, 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 while this was going down. It's like fading momentum. Okay. It's going up, but it's going up with less energy all the time. And now that it's gotten into some of these sharp angles here, that's a bit of an issue. What I'm going to look at chart wise is I'm going to look and see to what extent this bleeds over to the weekly, because you can see here the weekly is truth. Okay. When the weekly crosses over, it's great that you get the same position as right now, right? This was from about a year ago. All right. It's everybody wants to be this guy, right? Everybody wants to be the one that I bought here. Okay. I don't think of it as I sold here, I bought here. Okay. I sold here, I bought here. Who knows here? To me, that's not investing, that's speculating. And what you have to do instead is say, and I'm just using SPY as an example, it could be any security, any market. It all works the same. What I would rather do is say, I am always going to own some amount of SPY. Some people might say, well, on the extremes, I'll own 100%, I'll own 0%. But let's say you've decided that you're going to be between 20 and 80. 20% is the lowest you'll ever own, and 80 is the highest you'll ever own. Well, it's a lot easier to navigate this stuff if you've got something helping you to navigate it. And whether it's this or any other navigation tool, that's thinking like a portfolio manager. It may be one security, okay, one very popular security, which is making everything else chase it up and down. That's the stock market today. Doesn't mean in earnings season, all that stuff, we won't see things splinter off. But for how long? For how long? Okay. There's always headlines and events and things like that. But broadly speaking, the markets are highly correlated. I'm probably going to have to think of a better plain English name for a investment statistic called R squared, uh, because if you don't know what R squared is, it's going to get very, very important to people trying to be their own portfolio manager. R squared simply says, out of 100%, how much of the movement of this thing, this security, was determined by whatever you're R squaring it to. Assume S&P 500. So if you look at, and I'll move around here a little bit, get some of these other guys in the game. Okay. So here's the 11 S&P sectors. If we were to look at these over time, chances are they would all be fairly highly correlated to the S&P 500. Some more than others, a lot of them very highly correlated. And so that would be a high R squared. So like you might say, okay, tech and the stock market basically move in sync, okay, to a very large degree. So you might say that 80% of the reason that XLK goes up or down is because of the S&P 500 moving up and down. It's only moving independently of it 20% versus 80% dependent. How dependent are you on the market? And when you kind of lift that veil, so to speak, you start to realize that the key to investment performance, whether you define it as the market goes up and I go up more, not the most popular way for me to define it for myself. It's more a matter of, do I avoid big loss and then get my fair share of the ups? But even in that case, you want to know how much of your return as an investment manager, your own investment manager, how much of that return was because of active decisions you made to owning things that either embraced the market in the good times and didn't embrace it as much in the bad times, as opposed to, hey, my portfolio is up whatever X% the last 3 years. Good. So is the market. Maybe you wasted a lot of time. you know, that's the thing. And the market is making it so that overthinking these things is becoming much more damaging, I think, not just because it wastes some of our time that we could be spending doing other things, it also detracts our attention and distracts our attention from trying to actually find ways to make a difference in the markets. Um, so let me show you this because that's kind of the main portfolio manager's point of the day. Understanding how much is driven by the market and how much is driven not by the market. This takes a little while to load because we have so many of them here. Hey, welcome to your new playground. Um, as I say in the letter this week, they call us the market heat map. I'm sure that's good for SEO and all that stuff. But I was actually thinking of calling this the roar board. It's like a scoreboard of roar scores, except you see what we're doing here. Every week, we are trying to simplify this. You can always make it more complex, but here's what we've done. So start with the sectors. Here are the 11 S&P sectors right here, all the way down to utilities. For some people, they don't need to go beyond this. And increasingly, so many things in each of these sectors correlate. So what I'm doing in starting to use this myself is to look for places where there may be at least clues that things are not correlating, or as I noted in the letter today, if you look at something like dividend stocks, well, all the dividend stocks are in the green zone. See, one way we simplified this, and we're going to continue to do that, is that a higher score is going to be in the green zone, lower score, higher risk is going to be in the red. Remember, red is also where things bottom. So it may be red for a little while on the way down in a death plunge. I'll try to find an example of that. But then there comes a point where all of a sudden, red is where it springs forward from. Okay. To me, technical analysis is not catching bottoms and tops. That's what I use option collars for, and that's what I use call options for. I mean, I don't mind telling you that in the last week that the market has, all of a sudden found some footing. Not even in the last few days, I think. But I didn't make any big sudden moves in my portfolio, except as I saw the VIX start to come down, volatility was coming down, that made options cheap. And that to me was a clue that, hey, I don't think the market's going to go up, but who cares what I think? Instead, I started buying out of the money call options. Hey, market, you're down here. I dare you to go, not just a here, a percent or two. I dare you to go up 3-4% in a week. It's very cheap to get that uh, that what would you call it? That position, to put that position on. Okay, if it's a put option, you're buying protection. In this case, I was trying to say I'll put up X amount of dollars and that's it. I don't want to lose more than on what I put up. This is what I tend to do when the market is trying to figure out what the heck is going on. You see here, okay? Like talk to me up here and where it's not just bolting ahead. By the way, that could happen. But if that happens, okay, look, maybe the market. I mean, I got some call options. Let's see. I should be sharing as much as I can, even though it's very fluid. But um, I currently own a little slug of S&P or SPY call options at 720 strike price, all the way up here off the table. Okay. 720 strike price to May 15th is what I own. Uh, Enough of them so that if the market goes anywhere near that in the next month, it's going to be a little money spent to make a lot of money. convexity, as we sometimes call it. On the other hand, if the market falls 3% tomorrow, that might not have time to catch up, and the whole thing will go to zero. But that's just a different way to manage risk. In a portfolio context, the way we do it, I wanted to show this to you, but you can see just how many different levels there are. In fact, let's see here. Let's go back to the portfolios. Okay. And here is our basic stocks cash portfolio. SPY bill, SPY bill, SPY bill. Okay. I did note, I think last week, that this was starting to climb. I think it was at 40 a week ago. 2 weeks ago, it was at 20. So, I mean, look, I, I'm a risk manager at heart, but I learn over and over again that when Roar is moving, especially if it's moving steadily as it has done recently, um, it's never a guarantee of anything. But while in real world terms, with the war and all the other stuff going on, I'm a little surprised that the market is rallying like this. On the other hand, I'm not at all surprised because I've been getting this signal for a couple of weeks now. It knew, because obviously what are charts? What's technical analysis? Buying and selling pressure. At the end of the day, what is it that moves markets up or down? Buying and selling pressure, not a war, a Fed move, earnings announcement. Those are the events that may happen, but you ever notice how a lot of the time when those things happen, like, is already moving in that direction? And I don't mean because of insider trading. It's a whole another topic. But um, there's enough big money out there that doesn't care what any of us think, that we get these clues. And more, the markets are so mechanical that that I truly don't know if we're going to be sitting here a year from now and I'm going to care about more than 15 or 20 ETFs and maybe some stocks, but only when they're like way out of line. Okay. I mean, and I'll give you an example here before I go back to this one. We are all probably familiar with the plight of the software stocks. All of a sudden, they ain't got no business. Uh, and they're going to be replaced by AI, et cetera. I don't know if that's going to happen or not. But obviously, there was a clue here, okay? You've been at this 20 level for a little while. The key is that, what we don't want people to mistake the Roar score for, we talk about this internally all the time. It's like, how do we make it so that people don't look at something like this and say, "Oh, well, it was on green on November 3rd, and look at that, it fell almost 5%, and you had it at green." Isbits, you're worthless. That is not a good use of the Roar score, and that's why I say it works better, with ETFs, but it works even better with portfolios. In the same way that if you are right 65% of the time as an investment manager, well, Hall of Fame. About twice that of a batting average in the major leagues. So, when you get down into this area, it doesn't mean, it means the risk is high in the same way it was high here, in the same way it was high here. This is a pretty good example, actually, okay? The risk was still high. Could have been something else that vaulted this thing higher. Did that mean that the risk wasn't high? No. What it means is that, let's say, maybe it's a different way to express it. I've been saying well, there's a 20% chance that the next 10% move is going to be up versus down. I mean, that's a proxy. It's just to give you a sort of a human plain language reference point. Um, I guess the simpler way to say it is the next 10 times this happens, 2 times it'll lift off from here. Was that a 10% move? Yeah, exactly. 10% move. Okay. So it happened there. And, looks like it even just about happened there. But a lot of other times, not going to happen. And the more it just keeps hitting its head here and doesn't get out of the yellow zone, we're realizing more and more that a lot of things should be kind of neutral, yellow, so that the greens and the reds stand out a little bit more. I hope that makes sense. I'm kind of bringing you inside the laboratory here, but we're all kind of sitting around on a little, Roar engineering committee, and we're like, how do we make it so that people don't like pretend this is another buy and sell indicator? It is an indicator of how much risk you're taking when you take on trying to make a profit. That's what Roar is. Okay, so let's see. Actually, this is a good one to try this out with. So you can now take any security. Let's take IGV, and you can SPY bill it. Okay, see what it says here? IG, whatever you pull up, it's going to show up just like this. Okay, and it's going to give you a risk averse 2 ETF portfolio. Is it going to be a winning portfolio? I don't know. Is it going to be a well constructed portfolio? Is it going to be a well prepared portfolio? Why? Because you're not saying, hey, the market's going to go up. I'm going to buy software stocks. Everybody was wrong. They're idiots, blah, blah, blah. Okay. And then, but you're saying, all right, well, part of my portfolio may focus on this, but how much IGV do I own? This is what most of the street just skips over. And I think probably because it's too tough. It's one thing to tell people, hey, buy IGV, it's cheap. Great. The next question I have is, all right, how much? If I bought 0.5% of my portfolio, or if I bought way out of the money call options on it, can make a lot of money without putting up much. But if this analyst is telling me, oh, it's going to the moon, maybe I'll put 20% of my portfolio in it. And this is how a lot of younger investors think. Yeah, put 20% of my portfolio in it. You're not even thinking at all about anything around it. This is one position out of your whole portfolio, even though it itself owns, a basket of stocks. So again, it's that portfolio mentality that really I think is going to kind of take over the show here at our company, because yes, we feel like we have a great risk management tool, but we've got an even better portfolio construction mechanism. And we want to teach people to do this themselves. And the beauty of it is you can do it with entirely by yourself. Use our research, put together watch lists, look up scores, etc. That's one way to use it. And by the way, the site will be free for people who want to go in and just punch up tickers. Then up to 5 tickers a month. After 5 tickers, it's going to say $600 a year. That's what we decide. And pretty soon the 600 is going to go to 1,000, because this, the portfolio building part here and the risk management part, it requires a little bit of effort. There's a million places people can go to get their picks. So let's come back to this IGV. All right. We always use the bill. T-bill is a defensive asset. Okay. The benchmark, of course, is set to itself. Now, look, I don't know if it's going to work. I haven't looked at this before, but all we're really doing is saying, if the only two assets I can own are software, ETF, and T-bills, and I'm going to use the Roar score of IGV to set the portfolio. So what you'll see in a moment is that the current portfolio should be 20% IGV and 80% bill. And there you have it. Okay. What is this doing? Okay. I mean, the idea of this is not to be like, oh, okay, let me just go and set up that portfolio for myself forever and ever. I mean, if you do this with NVIDIA, you'll miss out on a lot of gains. Okay. But it will also inform you as to when, any individual security is starting to really get priced for perfection as opposed to either washed out or on a nice trend. So it's using Roar to determine that. Uh, you can see here, and let's see, because the last year has been the crazy year. Yeah, that's what I want to show. Okay, this is not about where did it end up. Okay, it's about the pattern. So if you had started a year ago and this was your portfolio, IGV according to the Roar score. So when the Roar score for IGV is 60, this would be 60. The other 40% is basically in zero return, except it's in T-bills because that's more realistic. And as you can see here, okay, we started $1,000. So uh, it's not keeping up with it. Of course not, because it would have to be 100% IGV for that to happen. But we're trying to be risk averse here. Okay. Then it starts to really hit the skids up here. All right. And maybe what I'll do is I'll go back and look at let's see, when was that peak? I guess the real peak here was around November 3rd. So I'll go back to that. Okay. And you can see it starts to flatten out. Why? Because it's filling in more bill for IGV. The other way to think of this is um, IGV is going to be at most a 5% position in my portfolio, and I have to be really optimistic to do it. 5%. And I'll also own as little as like a 0.5%. Well, then you can say, okay, whatever IGV's Roar score is, whatever the allocation is here, this is how I'm going to allocate that 5% of my portfolio. It's either going to be in IGV, going to be in cash, but it's going to really be a mixture almost all the time. Rarely is it 0 or 100. So in this case, you'd say, all right, I've got 5% of my portfolio that is targeted to own IGV over time. But instead of owning a 5% position over time, sometimes, like now, it's going to be a 1% position because 20% is 20% of 5 is 1. So this would be 1% and 5%. But wait, there's more. You see this over here? This is telling you how, and I'm going to change this default because I think it's a little bit too far off. Okay. This is how you build it. You might say, you know what? I am committed to taking a portion of my portfolio and I want at least 50%. Got to get those zeros out of there too. This zero. I'm committed to having half of my full position. This is how the pros think. Half of my full position. You want to call it equal weight, overweight, underweight. You can think of it that way too. My normal position is, let's say, 75. And my max position is, well, it's going to be 100. Okay. Not of the whole portfolio, of this part of the portfolio. And I can run that. And as you can see, in particular, if we look at it here, there we go. Didn't even have to target a different number. Okay. Look at what starts happening. If this doesn't look familiar, it should, because this is what a lot of Rob's portfolios look like. Okay. Except here, you can do it with any freaking ETF or stock you want. Okay. Or you can combine them. This is learning how to build portfolios. As we like to say, teaching you to fish. We hand you plenty of fish in here already. Okay. And look, it's not gonna flatline, okay? But I have to say, not bad, not bad. Breaking even through this. I mean, it kind of hung in there, right? That's what we want it. That's what we want it to do. And then you can go ahead and you can even look at the metrics on it. Okay. Well, my portfolio with IGV and Bill, half the gain. A lot that we're really going to emphasize standard deviation more, as well as R squared. As soon as they, I think, as soon as they can get that in there. Um, I love your impression. I mean, my guess is a lot of people don't know what a Sharpe ratio is. We might have to make that, kind of an extra thing and a Sortino and all that. What we don't want to do is bludgeon you with statistics, but we want to give you something where you can actually document and say, okay, that's it. All right. Um, so that's one way to do it. But here's another little wrinkle you can put in. Okay. Um, you can, oh, wait a minute. Let's see. Maybe you can't. Um, no, that's an enhancement. That's right. What I'm going to do, you can change the benchmark. Okay. How did my IGV portfolio do versus, I don't know. Okay. One of the main components in it. Yeah, maybe that's not functional yet. Yeah, the idea is to try to substitute the benchmark, but where I was going before was, um, you might decide in a portfolio like this, when I'm not in IGV, I want to be in something else. There are people who come up with these sort of, switching models all the time. I'm either in Tesla or I'm in Ford, something like that. Okay. But again, it's quite a playground, and arguably it's more than a lot of people need, but we're going to test the limits of that because we can always put stuff, you know, back in the closet, or what's more likely is we'll have a regular version for all but the greatest investment scientists out there. And then we'll have another version where, because it's all there, we'll just make it all available to you. But we haven't gotten that far yet. Okay. All part of a growing movement here toward teaching people to be portfolio managers. Okay. Anything else I want to hit here? Oh, if you like my bar chart articles, they're coming soon. Okay. Let's see. Yeah, we're trying to add a lot more of this stuff. Um, let's see, what else should I show? Oh, yes. Okay. Um, people always like to know, oh, Rob, well, what are you doing? What's most interesting to you? Um, I am literally today, tomorrow, going through and just making sure that all the stuff that they put out here is um, a good user experience. I'm the user experience guy, as you would imagine. Um, so, as an example, this says max drawdown 2.5%. I look at that and say, over what period of time? That I don't think it was that good. Okay, it had a max drawdown of 2.5%. Over what period of time? I'm guessing it's a year. Or maybe it could be, yeah, who knows? Who knows? Anyway, so those are the little kinks we're working out. Okay. But and I love that they added this. Again, I kind of have to review it and see, but I mean, this is really some top notch stuff. Okay, and I think it piggybacks on what a lot of other kind of fintech sites are doing, but unlike those sites, because I have worked with a few of them over time, they tend to do everything to try to impress you, and it's all about flash. And believe it or not, they goose up the performance results. Not here, obviously, but I have seen this before where they take everything and they basically say, well, wait a minute, let's jerry rig this thing to make it so that the numbers look better. Or let's just take this really good performance period and say that was the performance, all time or whatever. And you look at it and you're like, and then you've got an entire younger generation of people that are like, why am I not making 200% a year? Everybody else is. And, this is where I think it's really falling off the map for people. It frustrates me as a longtime fiduciary in this business, not anymore, but I think like one. And yeah, and I think everybody involved in this is like, we're going to try to cut straight through all the bullshit and make it so that um, anybody who wants to, for a pretty reasonable price, can build their own portfolios, and I can coach you on that. You can follow my lead and just do everything I do. It's set up to do that way, but um, you know, my ego is not so big that I need people throwing all their money into my strategy. It's flattering. It's there. Use it. Great. It's part of the service. Okay, the copy trading and all that. But you know, even if you do that eventually, the idea that you're doing it knowing how portfolio management works is just such an advantage. You don't have to know it inside out, but you have a much greater sense. One of the biggest issues back when I was an advisor was explaining to people, just kind of bring them down from their FOMO when their risk managed portfolio all of a sudden wasn't keeping up because the market went up 15% in 2 weeks. And why are we only up three? Um, and it goes back to, what are you trying to do? What are your objectives? We're going to build some things into here that hopefully are going to allow people to self-diagnose. What type of investor am I? How many ETFs might be good for me? And it's all a couple months down the road, I think, but it's all there. But it's that thing. We already built a research system to look at individual securities and RUR and all that. Now we're going the extra 50 miles and we're building the infrastructure so you can drop all that research into your own portfolio, a portfolio that we assist you in creating for yourself your way, or you hand it off and you have it copy traded, and I'm making the moves from my portfolio, and anybody who's paired with that, they get those moves instantly. So it's going to be up to you. Um, so I did want to tell you, and then there's an update on this in the letter as usual. What I am finding, let's see, not there. Is it there still? Maybe not. Yeah. Oh yeah. So these winning edges here. Okay, I have to go through this a bit, but um, it looks like it is figuring out. Got to be AI, right? I would assume. Um, okay. I'm trying to make it so that this is a little bit easier for folks to understand. So if you're using this, give us your feedback. Like, to me, it might be as simple as saying, hey, you know what? Maybe we don't need this. Maybe we just need a few bullet points in plain English about what's going on. Or maybe we don't need a whole lot of that at all. There's a lot in here. Frankly, more than I even need. Because at the end of the day, I want to know, am I making money because the decisions I'm making, that's the R squared we talked about before. Is my portfolio moving in a comfortable range for me? And that would be your standard deviation. An 8 standard deviation is extremely low. And max drawdown is helpful, but it's really more a matter of, like, if I, again, just looking at these numbers because they're up here. Okay, if I can earn more than double the return, and this is 10 ETF portfolio. I mean, yeah, this is the main show for me. Okay, this one in the Dow portfolio, because I'm going to show you that before we finish. 10 ETF, RUR 10 as we call it. Okay, produce nice return over AUM, the moderate allocation index. And we've been starting to add a lot more of this data here. Okay, it's great that there's alpha over it. Okay, but it's this. It's one thing to produce a 9% return, but usually a 9% return, that's like a market long-term average. The stock market's long-term average is about a 9-10% return, probably closer to 9, and a standard deviation probably 16, 17. So you're getting, at least over this period of time, a normal return with about half the range of returns. Okay, this is like where the returns normally fall, your 1 year return. Okay, This won't be the last time I explain it. It's kind of like saying, hey, 9% was your return, but about two-thirds of the time you were 8% either side of that. And then about 95% of the time you were two standard deviations within that. So you'd, let's say, add 16 and subtract 16, you'd be up 25 or down 7. So up 25 to down 7. Is up 25 as your best year and down 7 as your worst year with 95% confidence? Is that a good spot to be in? I take that all day long. That's why I love this portfolio as my main one. But you can take that, you can pick it apart, and you can redesign it for yourself, or you can just follow along for a while and then decide if it's easier for you to do that because they're not charging that much. Okay, I wanted to look at this, okay, because I'm also trying to show you what do I look at. So the two things I look at, I mean, I look at the Roar 10 obviously, and tomorrow morning I'll make the updated, I'll confirm the model changes, and I literally go in myself in an app of all things, and I simply say rebalance to this, go, and the trades are done. Amazing. This is the other sort of prime portfolio. I don't know what they call it. I think I would call it super portfolio, super portfolios. Okay. I didn't go with that one, but anyway. Okay. Why? I'm a big fan of the Dow. I always thought that if you took the Dow 30 and you just weighted them according to technicals, Roar score, if you did that with the Dow 30, you could have a pretty good portfolio. I think it would certainly beat the Dow most of the time. Would it be competitive with the S&P and the Nasdaq? Don't know. But honestly, I don't need to be competitive with the S&P and the Nasdaq. I'm trying to go for a controlled experience. So, sure enough, what I do here, and I'm still not really much into stock picking these days because I think most of them just correlate with each other. And maybe there's an outlier. But if I'm going to find an outlier, where am I likely to find it? I'm likely to find it in a portfolio that every day automatically looks at all 30 Dow stocks and it tells me what position size should be in each of the stocks to come up with the best combination. It's not using optimization or that type of garbage, whatever. Okay. It's just looking at the individual Roar scores and it's weighting them according to that. So as you see, hey, something like CVX, well, that's interesting. Guess it was right on the oil thing if CVX is down to 1. Okay. CRM was part of that embattled software sector. And it's up to a 3% position. Apple, which I think I pointed out a couple of weeks ago, has had some up days, some down days, but there are not too many 5% positions in there. So, I'm looking at this also. Yeah, there's Travelers, okay, and I guess J.P. Morgan too. So, I mean, look, this is to me a a great way to look at any set of securities. You can create a portfolio like this and put in your own tickers, and it will tell you what it thinks the allocations should be. So this is much more than should I buy or should I sell? Because the way I think as a portfolio builder is I don't want to be. Remember what I said before? It's like, as soon as these things bottom, they're going to fly on day one. And as soon as oil hits the bottom and the war news gets bad again, then all of a sudden this will go, give me my little 1% position as opposed to exiting and entering entirely. The binary investment approach that everybody seems to use, not me. I'm all in, I'm all out. Why are we making this like a coin flip all the time? Investing is not a coin flip. It's a process of measured responses, reactions, and combining different securities together. That's portfolio management. That's investing. So I'm going to stop there because that's enough brain power for one day. Questions? uh, about the markets, about anything I've shown you here. Tried to give you kind of a broad tour. I think we covered just about everything. I'm sure there's more in here I didn't. Um, but we've added a bit more to here. Even have an FAQ section here. I'm going back now, just so you know, through literally like over 1,000 pages of my written work. And I said, hey, I don't know if you can do this, but if you guys at PyTrade can load in all that stuff, and I'll come up with like, I don't know, 1,000 FAQs, just investment FAQs, uh, so that you got a whole library. I see what you can do with AI. It's like, why can't you do RAI? My middle name's Alan, so I'm RAI. Why can't you just go in and say, okay, here's a question for Rob, and then it will give you a Rob style response because I probably wrote it 2 years ago or 20 years ago. That would be that would be a great learning tool. And again, it's where we finished all the frontline stuff, but there's a lot more we can add to this to make it a real ongoing learning center. Okay, describe how to use this Sharpe ratio. Not much. I don't. Truth be told, there's somebody in the sort of extended community of people that are working on this who apparently is a big fan of Sharpe ratio as a review. And let me find one. I'll just pick out anyone. Okay. Let's see. Let's pick out tech because I think I know what the answer is. Actually, you know what? We got to do it at the portfolio level. So let's do that. We'll just do it at a portfolio level instead. Um, I want to keep it simple. So let me go back to this one. I'll just go to SPY build, the simple one. And if I pull up the metrics here, okay. So again, this is SPY build. It depends what you're comparing it against. The benchmark for this is a conservative portfolio because again, I'm not saying be in SPY 100% the whole time. I'm saying, whatever the Roar score of SPY is, that's your allocation to SPY. Whatever the rest of it goes to bill. So what is the Sharpe ratio? The Sharpe ratio technically is return per unit of risk. So what this is saying is, are you getting more return? If you have a positive Sharpe ratio, then you're getting bang for the buck. That's really what it means. Okay. You're getting bang for the buck. All right. And really, when you think about it, that's kind of the whole definition of what I told you at the beginning of this session, which is I am all about acknowledging that anything can go up at any time for any reason, from any price level. But how much risk are you taking? Well, the decisions that we make as portfolio constructors for ourselves, the decisions we make about how much risk to take, our exam, the test of that is how much return did we actually get more return for the risk we took? A 30-70, 30 stocks, 70 bond portfolio the last several years has been about as advertised. It hasn't added any value for the risk it took. So why take the risk? Whereas this one has. But here's the issue with the Sharpe ratio. Okay. Bill Sharpe won a Nobel Prize for it. However, the Sharpe ratio only looks at it treats up markets and down markets the same. And in reality, what is it we're really looking for when we test ourselves? It's not, if it's return per unit of risk, what we really mean is not volatile. Like if it was volatile on the way up, great. If it's volatile on the way down and we're losing a lot, right? I mean, the market's been volatile the last few days on the way up. And who's complaining if they're, heavily long stocks? Nobody. It's when it goes down. And so that's why a guy named Sortino came along after Sharp and basically said, I see your Sharp ratio and I raise you a focus on the down markets, please. And so Sortino really just looks at that same question. For the risk I'm taking, how much reward am I getting? Reward per unit of risk. It is doing it only based on the downside. And as you can see, that's where a lot of these portfolios should shine. You see how that's pretty good. That's even better because I'm a downside protection specialist above all else. The issue we have right now, to be honest, is too many numbers floating around here. And I don't know how to best deliver this. Given what I've seen from AI, I'm going to see, I'm not a programmer, but I'm going to see if the programmers can maybe say, you know what? And you guys tell me what you think, here, or notes, chat, email, whatever. As I see it, rather than have all these numbers here, this is different time frames. So these are all the numbers we have, and you can see capture ratios up and down, beta alpha, okay. I see what they're doing by saying, hey, these are the things you should know. See, 72% better Sortino ratio, better Sharp ratio, annualized outperformance. That's great. Those are great headlines. But I think what I would rather do is come up with some sort of like bottom line, a few bullets on you did this well, you did this fairly well, and this you're about average. But I don't know what blanks to fill in. Is it how good did you do in taking risk? How well did you do in perform? I'm not sure. Too early stage because I've only had access to this for like 48 hours. So uh, I'll let you guys know. All right. Okay. Any other questions and feedback, especially? I mean, what do you think? These live sessions are gonna be a little bit more, I guess, like a classroom. We kind of thought, hey, should we offer a course of sorts for people to say, gee, I don't want to pay to join the site. Okay, fine. Maybe there's a course they can take. Um, but I think more and more I'm realizing that, you pay for the service for a year and you're getting all this and you're getting an ongoing course. Um, Maybe not an hour a week, every single week as we've been doing, but there's a lot of learning to do. And, we'll have videos and things like that to try to cut it. The whole idea is to allow you to create your own process and make it really like clockwork for you, but it doesn't have to be like anybody else's. I'm not the type that says, "Oh, just follow me and I'll, lead you to the promised land." Happy to do that, set up to do it, but my understanding from working with so many self-directed investors now the last 6 years is that they'd love to copy off my paper. I say go for it, okay? And there's ways to do that. And over time, they're going to decide how much they want to copy off Rob's paper, how much do they want to learn from that and experiment on their own, and how much do they just want to be, completely independent. All are available, and it's up to you to decide how you spend your portfolio learning and construction time. Questions before we close up?
Yeah, Rob, I had a question. Do you mind
Yes.
if I speak? Or
I prefer when people speak the questions. Yes.
okay, so this is really interesting. I really like what you're doing.
Thank you.
So I have two comments on this.
Hmm.
They're kind of related. You're doing research, and you're that's it's great. You have all these tools. You're doing the research, but the actual goal is not so clear. And so if you have, instead of naming these portfolios like this one, stocks, cash to ETF, but you must have had a goal in mind for that. Is that, and it could be related to one of the numbers, it could be related to, the the greatest difference in the return and the standard deviation, or it could be related to just the lowest amount of drawdown or something. But I think,
Objective, right? You're saying it's nice to see the portfolios, and we're going to be adding more, but but you like to see them classified, uh, perhaps on which ones have the highest upside potential, which ones manage. What are they really trying to accomplish, right?
yeah, and
Hmm.
then you could have that as your benchmark for that portfolio, because you'd set it. And then
Yep.
just one thing to consider as you're,
By the way, that's a very quick answer. You just correctly named, what was that show? Family Feud. If you get that was our number one answer. Okay. That is the number one thing on Rob's list from the programmers to say, uh, can you characterize all the portfolios so that this page flows in exactly the way you said, so that people can separate one from the other? Coming very soon. Now, in the meantime, okay, if you see this, the benchmark here is the Dow. Okay, benchmark here is SPY. That tells you right away that these are more aggressive portfolios. We don't say what this is unless you maybe look in here. Okay, but that's a moderate risk portfolio. That's why we use these. That's a 60/40 kind of growthy portfolio, and that's a conservative mix portfolio. There needs to be cleaner documentation of this, but it's exactly what you're saying. That's why this is where I have a lot of work to do.
yeah, I mean, just to go with it. So Dow 30,
Mhm.
yeah, but I mean, you're doing such great work. You want it to be more explanatory. And then just one thing to think about for a portfolio. These are all kind of balanced. But what if, and like for my case, I own stock. I'm okay with that, and
Hmm.
hard to get rid of, with capital gains and things.
Oh yeah.
But I'd want a portfolio, and I've been doing this of to protect on the downside. And so you could have a portfolio, it would seem like, where you max out on this Sartino, I may
Hmm.
get it wrong,
Sortino, yep. Hmm.
and you don't care about the upside. I mean, you label it like this, but this is the best downside protection, without, just buying, bill or something like that. Having it kind of be just a defensive. The goal is just a defensive
Oh, just of it.
portfolio.
So, in other words, it's kind of like you're saying, "Hey, I've got a stock portfolio, but in a different account, let's say at my broker, I'm going to have something that is only designed to make money in bad markets," kind of thing.
Yeah, to,
Hmm.
to
Yeah.
provide, the ballast with, without like I said, without just going into, a bank account. I mean, so it's
Yes.
something a little
Yep.
smarter than that.
Yeah. The closest we get. I mean, look, this portfolio is supposed to be all weather. Okay. Um, you need a market to in an extended bear market, this portfolio has a fighting chance, 10 ETF, to make money. And so does hedge equity, because it takes SPY bill and it adds VIXI, which means when the market really, really spikes and volatility stays up for a while, not when it spikes all the way up, but when it goes up and it stays elevated, um, and doesn't come down, this also has a fighting chance. Okay, this one has almost no chance because There's no inverse position. It's just stocks and cash. However, keeping your streak intact of always asking timely questions. There's a few open holes here. I've got a few more portfolios I'm creating, and I don't know if any of you remember the Prudent Bear Fund. Um, a guy named David Tice, who ran at the time, as when we were mutual funds and no ETFs. But he ran something called the Prudent Bear Mutual Fund, and the goal was to make money in down markets and in up markets, at least try to like not lose. Okay. So if the stock market goes up 20% and this makes a T bills plus 1%, good enough. Okay. Maybe even T bills ish. But if the market falls, you want to get most of the downs, but in reverse. Okay. And again, just like all these portfolios, you can put them together, and you can then go in and I think you can do that. Maybe you can. No, but you can recreate it, and then you can go in and break it apart yourself by creating a portfolio. So just so you know, one of the remaining portfolios I've not yet finished designing is one where the objective is, in an extended bear market, crush it. In an extended bull market, just try to put up a plus sign, as much as you can. It's like the great opposite. Okay, it's tougher to do just with ETFs, but I think there's enough like volatility ETFs and stuff like that. Not to mention, I mean, look, what makes it really tough now is, I think you might have come in a little bit after I mentioned this, but everything's so highly correlated now. It's like try finding stocks that over an extended period where the market is way down are actually up. Almost none. And as a result, it's not like we can be, oh, buy this sector when it's, whatever. Okay. But what we can do, and this is what I'm working on, is to go in and just say, all right, it won't be these 10, but let me find, I don't know, 5 or 10 others where a couple of them are kind of offense, but most of them are defense, kind of like pick your own hedge. And then, like all the others, put the Roar score to work. And if it turns out that all the inverse ETFs that are shorting small caps and large caps and whatever, if they're all indicating markets going down, make money on the way down by having these inverses go up, well, then it will just allocate to those. The question is going to be, is there drag when you get these whipsaws? My guess is the portfolio that you asked for is very buildable, and I think I'm on the way to building it. What I would also expect is that in markets like the exact one that we just have, okay, down and up. Well, my old expression for this, when it happens that quickly, the rebound is that fast. I mean, look at that. Boom. Okay. Gap up. When it happens that fast, as I say, you can't drive 60 miles an hour in both directions at the same time. So if you're poised for this, and especially in a devout defensive, there's no signal here. It happens in a moment, and this time it wasn't a false signal, okay, like this one was. And that's the thing with technicals. It's high probability investing. It's not perfect investing. So other than that, okay, with the idea that, and I think your intention is exactly right. If you're going to create that portfolio, it's not so you can try to, you know, make a killing on the way down and then get out of the way when it goes up. You're saying, I want something that is going to be a great defensive tool, but yeah, it can play a little offense too. It just needs a lot of help. Market might have to go up 15% in a year for it to make more than 4 or 5% because it's a role player. And if it's a role player, if we're even using that term, that means we're thinking like portfolio managers because portfolio managers look at everything that's in the portfolio as something that gets them to the goal, whether it's 10 different building blocks like we have in the main one here, or a set of stocks or anything like that. Portfolio management just building blocks, putting the puzzle together and rotating the pieces as need be. All right. Any other questions? I hope this was fun, educational, or at least one of those two. All right. Thank you all. See you soon.